Hello, good morning, everyone. Welcome to our Phillip Securities Research Morning Call for 21st April 2025. For today, we have few results on US banks, Bank of America Corporation, Keppel DC REIT, and an initiation on Soilbuild Construction Group Ltd, and a few updates on Microsoft Corporation and Group Airbnb, and Phillip on the ground for TSMC, ASML Holding, Keppel Pacific US REIT, and Capital and Commercial C REIT. And also macro and sector outlook for Singapore Monthly on Banking, REIT, and Air Transport, and also Singapore Weekly. And also, as usual, our technical analysis on the S&P 500. Now, moving on to the next slide is our usual disclaimer. Everything we take it is from the public sources and serve for education purposes only. So please do reach out to your financial advisor before you make any form of investment. First, we'd like to update on Microsoft. We like to reiterate our investment thesis on this counter. First, Microsoft is surging ahead in the AI wave. Microsoft has more than doubled its data center capacity over the past 3 years to meet the rising demand for AI offerings and plans to further invest $80 billion on building AI data center in financial year 2025. Additionally, the company's AI-related revenue hit a 13 billion run rate in second quarter 2025, exceeding its $10 billion target. Second, accelerating Azure AI growth through expanded AI capacity. From the chart on the right side, we could see the contribution from AI services into Azure and cloud services has steadily increased over the quarters. And in the recent second quarter 2025, the AI services contribution was up 175% year-on-year basis. We expect significant growth in Azure revenue in financial year 2025, which remained at 30% revenue growth and is indeed in the previous quarters, driven by expanded AI capacity from ongoing data center expansion. Finally, we see strong demand for Office 365 to continue. Microsoft Office 365 is the world's second most used office productivity software with 30% market share and dominant US presence. For the outlook for third quarter 25, Microsoft expects total revenue to grow 10% year-on-year basis, and the intelligent cloud revenue is projected to grow 20% year-on-year, led by Azure revenue growth up to 31% year-on-year, driven by strong demand AI and cloud offerings. Management anticipates Azure growth accelerating in second half 2025 as additional data center capacity comes online. Productivity and business process revenue is expected to grow 12% year-on-year. The more personal computing segment revenue is expected to remain flat year-on-year. We expect minimal impact from tariff and continue to see strong CapEx momentum and growth ahead. While some early stages CapEx projects may face delay and cancellation driven by the rising tariff-related costs, we still think this is only representing a minor pullback, about 1 to 2% of its planned $80 billion financial year 25 full capex, and this reflects a strategic pacing, not a broader slowdown. We see no major revenue decline supported by Microsoft Cloud revenue dominance and long-term customer contracts. To conclude, we upgrade to buy from accumulate due to the recent price performance with unchanged DCF target of $480. This is on the back of Microsoft rising AI growth through cloud and services that remain intact. Moving on to the next slide is on Airbnb update. For our investment highlight, Airbnb is short-term rental powerhouse. They dominate the STR, which is short-term rental powerhouse for short market, with their 8 million active listing and 5 million hosts across 220 countries globally. This is coming from STR bookings, make up 80% of their total bookings. And Airbnb has successfully increased their market share by 16% over the past 5 years. This comes from consumer demand for diverse and personalized alternative accommodation, which Airbnb had managed to deliver. We believe Airbnb is well positioned to capture a significant share of the STR market, which is expected to grow at 11% CAGR over the next 5 years. Next, Airbnb has a scalable asset-light business model. Airbnb's asset-light platform model drives scalable growth without owning any properties, making it less capital intensive. Over the past 3 years, active listing rose 25% and increased gross booking volume by 74%. This demonstrates strong demand and growing platform adoption. Lastly, accelerating growth in the emerging market. This region have low vacation rental penetration of 7 to 8% and could provide ample room for expansion. In financial year 24, we see booking volume emerging market growing twice the rate of the core markets, where growth has slowed down post-pandemic. We expect continued double-digit growth in these regions, driven by the rising incomes and strong demand for personalized experience. For the outlook, Airbnb plans to invest 200 million to 250 million in new businesses launching in May 2025. The company aims to expand its revenue stream beyond short-term rentals and eventually generates 1 billion in revenue as they scale over the coming years. Despite the investment, the company expects to maintain strong profitability, delivering a full-year adjusted EBITDA margin of at least 34%. We anticipate a moderate impact from tariff on Airbnb, as a weaker economic outlook and softening consumer sentiment may dampen international travel demand, especially on the United States, which account for 42% of Airbnb revenue in financial year 2024, could experience near-term softness in inbound travel due to the rising geopolitical tensions and retaliatory trade measures. Overall, we expect these factors to weigh on travel demand and impacts earnings in the near term. And we upgrade to neutral from reduced recommendation following the recent price performance, but with a reduced DCF target price to 112 from previously 120. Despite the great investment thesis, weakening US travel demand with significant decline in the international interest and the possibility with the uncertainty coming from the tariffs, this leaves the investors less confidence and hence our reduce in the DCF target price. That's all from me. Leave it to Glenn for the US banks.
Yes, thanks, Vami. Yeah, so for the banks, we have we'll just do a very quick review and recap of the first quarter results, for four of the largest banks in the US. And next slide, please. Yeah, so for the review, we do have, what we've seen, it seems sort of a pattern is that net interest income, has been quite flattish, with the outlier being Wells Fargo. So they weren't able to really outpace their cost of funds. They didn't give a reason why, but there could be many reasons. Maybe they couldn't reduce, their deposit costs, or they couldn't move a lot of their assets into CASA. So that's probably one of the reasons why they underperformed, and their stock price did take a bit of a hit compared to the other banks. For the rest, they were able to outpace the cost of funds, the decline, compared to the loan yield decline. So that's why we see an improvement in the net interest income and also an improvement slightly in the net interest margins. Non-interest income was also mainly the driver for growth, at least for JP Morgan and Bank of America. Wells Fargo, again, they didn't really perform very well in the non-interest income department. So that's why their results weren't as good as the rest. Investment banking wasn't as healthy as it was, for the last few quarters. And that's really also due to a lot of companies, they were holding off on deals, while they wait out to see how the macroeconomic uncertainties sort of play out. So we could see a further decline in investment banking growth in the next coming quarters. Asset management was still quite stable. I think the biggest improvement for the banks was the trading income, as the first quarter saw this huge spike in volatility, and hence we saw trading income sort of do quite well. Provisions wise, if you look, the outlier here would be JP Morgan, right? It was plus 1.4 billion. This was really due to not so much that the credit quality has declined, but that they were putting on a lot of reserves. So the last few quarters, they were trying to release their reserves, but now they realize that they will need to build it up a little bit more in times of uncertainty. They're not sure what will happen, so they're building up a little bit more of their reserves. Net, if you look at the EPS, I think all the banks have done relatively well. I think the biggest and the most important thing would be that the banks have actually maintained their guidance or even increased it very slightly. So JP Morgan raised their net interest income guidance from 14 billion to 14.5 billion, whereas the rest have just sort of maintained it as what they have said in the previous quarter. So that just shows confidence that the banks have, in terms of where they see the growth and the earnings going, at least for the rest of the year, despite all that's happening macro-wise. Now, moving on to the next counter, we have Bank of America. Yeah, so for Bank of America, we'll just be going through their first quarter results in more detail. So their first quarter earnings was quite good. It rose 11% year on year to 7.4 billion, but it was still slightly below our estimates, with the earnings at first quarter earnings at 24% of our forecast. I think this is mainly due to sort of me being a bit over optimistic with how well they'll be doing in this year, sorry. Yeah, so positives. The first positive is their net interest income, like I mentioned earlier, has improved from their lower costs. So the lower deposit costs and funding costs really was the main difference, and that's what made their net interest margins as well as their net interest income improve. And we do expect this to continue as the lower deposit costs as well as some loans growth will cushion the NII, and we could see mid-single digit kind of growth for net interest income. The investment and brokerage fees have also surged, so this was coming from both the asset management fees and as well as their global markets or trading revenue. So trading revenue was up mainly from the higher FICC revenue as well as higher equities revenue from the heightened volatility that we have seen. And so the main negative is that the provisions have risen. So this is also similar to JP Morgan, but at a smaller scale, where they have started to build up their reserves. So they did have a reserve build of 28 million. Compared to the previous year, it was a release of 179 million. So if you take that difference, right, that's why there's such a big difference in the provisions, and it rose by 12% year on year. As for the outlook, they have maintained their guidance. So they're still guiding for net interest income to come in 6 to 7% higher than FY25, and that it will sort of grow more in the following two quarters of the year instead of the first and second quarter. And this main growth driver will come from their fixed rate asset repricing as well as the lower funding costs that they'll be seeing as they move forward into the rest of the year. For expenses wise, it will be a slower growth at only 2 to 3% year on year. As for the Trump's tariffs, they do not have a direct impact on the US banks, but there's of course a lot of indirect impacts. And the main ones being that they will be having slower growth as the consumers and businesses hold back due to the uncertainties around their costs. So this could possibly lower slower loans growth as well as higher provisions from the higher defaults as well as higher unemployment. And last but not least, for Bank of America, we are seeing that they could have lower IB fees as the clients wait for more clarity on trade policies and they hold off on committing to deals. So Bank of America did, acknowledge the tariffs as well as the trade war, and they said that this could actually alter future spending, but they show that their first quarter data at least have shown a steady 4.4% year-on-year consumer spending, and together with their robust business fundamentals, it supports a view of a bit of a moderated GDP growth. So definitely slower, but that they don't expect a recession, more importantly, in 2025. We do upgrade to a buy with a lower target price of $45, and mainly due to the recent share price performance. And we do like Bank of America the best amongst the rest, at least the other banks for now, because of its substantial investment and brokerage segment, which contributes 18% of their revenue, and its ability to also keep their net interest income stable during volatile periods like this. Yeah, so that's for Bank of America. Now let's move on to the Singapore banks. Yeah, Singapore banks, next slide. Yeah, so I think we do maintain, just to put it out there, we do maintain an overweight for the bank. So I'll just explain in detail why we do that. And our title is also that the banks will be the pillars during the volatility, especially during these times. Yeah, so just touching firstly on the interest rates, rates were down again, right? Nothing new. I guess this is to be expected. SORA was down by 20 basis month on month to 2.62%, and it was also about 18 basis points lower than the first quarter average. we do expect this to continue as the more Fed rate cuts are expected. For the HIBOR, it was also it was quite stable, but if you look at the trend, the blue line here, it's actually going down also together with the Fed rate cuts. So we also expect that to continue. Now moving on to the loans growth. Yeah, so this is February numbers. We get there's a bit of a lag and a delay in terms of the loans data that we get from MAS. So for February figures, it's still quite positive. It's growing at 4.9%, so mid-single digit. Slightly declined from the last 2 months, but it's still the third highest loans growth if you look at it since August 2022. And we still do expect mid-single digit loans growth for 2025 as it's expected to recover further from the additional rate cuts. But then again, a caveat that this might be hampered by the trade war. So as of the last results, so the last fourth quarter results, the banks have mostly guided for a mid-single digit loans growth in 2025. And I think we'll get more clarity I think 2 weeks' time when the banks release their results in the first week of May, where we'll see if they revise this downwards. Maybe they might look at single digit or a bit on the lower end of the mid-single digit loans growth. As for loans, business loans were healthy as well. The building and construction as well as the manufacturing segment rose by 5% and 6% respectively. So manufacturing segment, they did actually a rebound, right? If you look at the last 2 months, they were rebounded 5 and then 6% now. So we could see that actually lowering when we move into the rest of the year, when the tariffs, when the trade war really kicks in and we start to feel it. Consumer loans were also quite stable, growing around 4%, mainly contributed by the housing loans. I think more importantly, the deposits and balances has grown by 7%, and the CASA ratio or current account and savings accounts proportion has risen to 19% from 18.6% the previous month. So this is one of the, I think the first time it has reached this 19% in about a year or two. So it's quite why is this so important? It's because the current account and savings account, so it's something like your current account, DBS multiplier, UOB, OCBC 360, that kind of account, UOB one account. So that's basically free funding for the banks, right? The base interest for those accounts are very, very low. I think it's like 0.05%. So the higher the ratio, it means that the cost of funds for the banks will be lower, and then the banks will be able to put these deposits into sort of longer tenure interest earning assets where they can earn that spread. So that's why a higher CASA ratio is usually more beneficial and it will be more positive for the banks. We do expect moving forward that the CASA ratio will continue to increase as the higher interest fixed deposits that we all enjoyed a year ago, they start to mature, and all these funds get shifted back to CASA, because now with uncertainty, we're not sure where's the best place to put, so we will put it back into CASA. So this will be beneficial for the banks. Now moving on to the next slide, we're looking at the SGX statistics. Yeah, so this is basically showing the SDAV and the DDAV, which is the volumes, the securities as well as the derivatives volumes, and both have in March at least they have grown by 25% year on year as well as 12% year on year respectively. So for first quarter, we are seeing very good volumes growth by 19% and 10% respectively for SDAV and DDAV. And this is also attributed to the VIX, which is a market index that measures the implied volatility of the S&P 500. It was up to 21.8 in March, and this is notably higher than February 17. So we could see a further spike up, and we are looking at whatever data we have now for April at least. We will definitely see a much higher increase in the VIX and consequently also in the trading volumes. And this will be beneficial for not only SGX because they depend highly on the volumes, but also for the banks in terms of their trading income. And we could see that will be one of the good, one of the good segments for the banks in terms of volatility. Yeah, so that's all for the SGX statistics. Now let's move on to the bank's performance. Yeah, so this is a bit of old news because this is for March. So the increase was only 0.5%. There wasn't really much movement in the banks. And this was really also due to a bit of hesitancy as a lot of the investors were waiting for the tariffs, where which were announced, where he said that he was going to announce something on Liberation Day on 2nd April. So I guess it was a bit more quiet for the bank's share price, during the March period, because a lot of people were waiting to see what will he announce. Now moving on to my second last slide, sorry. Yeah, next slide, sorry. Yep. So for, I think there's become a lot of questions on the impact of Trump's tariffs, especially on the Singapore banks. So the trade war, we feel does not directly impact the Singapore banks, but there are of course a lot of indirect risks from a slowing economy. So I think the three main things will be the rising bad debt provisions, the falling interest rates and margins, as well as the slower loans growth. Right. So, but we believe, that firstly, that the provisions will be quite stable because, and this is mainly that it will come in within the expectations as they have not really had a credit boom during this provisioning cycle. So the loans if you look at the loans growth for the past 3 years, it's only grown at 2.5% CAGR. And also, I think more importantly, is that the banks have set aside quite a large amount of management overlay that they are able to use to offset the general provisions if specific provisions come in too high. So credit costs, we believe, will come in quite stable. Secondly, the NIMs and net interest income will remain quite stable and they will stabilize mainly due to the steepening yield curve as well as higher CASA levels, which I mentioned earlier. And this will ease the margin pressure that we'll see from the lower rates. And last but not least, the slower loans growth, it might come in slower than what they were previously guiding for, but we believe that the rebound in property sales as well as the need for additional liquidity could keep the loan demand elevated. And also, if you look at the three Singapore banks, right, where their sectors as well as the geography is, the ones that are most affected by tariffs, so we're looking at manufacturing and ASEAN, only makes up 7 and 15% respectively of the bank's total loan book. So if you look in a larger scale, they're not as affected or as impacted by the tariffs, even indirectly. So that's why we believe that the banks will sustain, the healthy earnings. And last but not least, I know it's not on this slide, but for the dividends wise, I believe that the banks will continue to pay out what they have promised. At least, for DBS, they have I think maybe it's beneficial for investors and shareholders, but they did set their dividend policy as well as the special dividend payout and the capital returns in sort of dollar value, right? So they said how much they're going to give out, right? So for DBS, that's quite set in stone. I think they'll be continuing to pay out. And also, if you have followed, they have recently done a lot of share buybacks. So it's a sign of confidence that they have enough capital to even do buybacks and that they'll be giving out dividends. However, there's a bit of a risk for the other two banks because their dividend policy is based on earnings. So they are giving 50% base dividend payout ratio on top of a 10% dividend payout for special dividends. So in terms of that, if earnings do decline, then we could see that this special dividend and the dividend payout ratio will both decline as well. Yeah, but I don't think they will remove that 10% special dividend payout ratio for whatever they have promised in the timeline. Yeah, so let's move on to the next slide. Yeah, so we do maintain overweight, and we believe that the banks are really the pillars for during these volatile times, for what all I've mentioned. And yeah, so that's all I have for the Singapore banks. I'll now hand it over to Darren. Thanks. Oh, sorry. Yeah, to Darren. Thanks.
Yeah, thanks, Glenn. Yeah, so for Keppel DC REIT, this is a first quarter operational update for them. So basically for them, their first quarter performance was quite good because it was driven, the DPU rose by 14%. That was driven by the acquisitions of Keppel DC Singapore 7 and 8. So that was in line with our expectations. And they also benefited from finance cost savings or interest savings because they repaid some of the loans with the proceeds from the cluster-backed data center divestment, as well as lower interest rates. Yeah, so for the positives for the portfolio is that the portfolio remains relatively healthy occupancy at 96.5%. So there was a slight dip at the SGP1, but the rest of the portfolio remains relatively stable. So for the remainder of FY25, the majority of leases that expire will come in the second quarter. So that is at SGP4, and that is a Singapore co-location lease. So remember in the past few quarters, they had 30-40% positive rent reversion when they refinance or sorry, when they recontracted or renewed the lease for some of the major tenants at the Singapore co-location data center. So we are expecting a similar kind of 30-40% rent reversion for the upcoming second quarter major contract renewal as well. So that is for the next quarter, but for the first quarter, the rent reversion was 7%. So that mainly came from the smaller lease renewals, and no major lease renewals were signed, and came from a little bit in Singapore and Dublin. Yeah, so another positive is that, like I mentioned, they have lower finance costs, so their cost of debt remains stable, and they are 68% hedged. So for them, they forward hedge their foreign source income. So for now, it's hedged until the end of 2025 substantially. And for the gearing, right now it dipped to 30.2%, but it's expected to increase to 35% when they draw down more debt, basically to finance a land lease extension at SGP 7 and 8. So that will be about 350 million Singapore dollars that they'll draw down, and as a result, the gearing will rise to about 35%. Yeah, but for them right now, the negative is still that the Guangdong data center is still facing some issues. The tenant is still not paying rent. So it continues to, basically the arrears continues to accumulate. It's been accumulating for over 1 year already. So right now is they owe about 35 million, or slightly more than 35 million owed today in overdue rent. And for now, there's still no clear timeline or any indication that they'll be able to pay anytime soon. Yeah. So for the outlook, right now, there are more headwinds like evolving AI governance and tariffs, like geopolitical developments. So all these might add some more regulatory complexity and uncertainty to the data center demand. But for now, Keppel DC, they mentioned that they do not see any pullback from any tenants, and their negotiations are still, tenants are not pulling back for now. So negotiations are still the same. Yeah, and regarding the chip supply restrictions, the Keppel DC, they do not see any significant impact on them, but that's mainly because for the majority of the portfolio, they do not handle training AI workloads. So Keppel DC, they handle more of the inference type of workloads, which require less computing power, so are not so compute intensive as training workloads. So for that, they do not see that any requirements, GPU requirements that our tenants need at their facilities. It will not, or it's not expected to reach the heavy regulated thresholds. Yeah, so with that, we do not change our target price. So it remains at $2.25, but due to the recent share price performance, the share price, it fell quite significantly. So because of that, our call is now upgraded to an accumulate. And because of the increase in DPU, the forward yield is now at 5%. So this 5% yield is high compared to historically, where it usually trade around 4+%. Yeah, next slide, please. Yeah, so I'll now talk about our Singapore REIT monthly. So we expect a more volatility ahead because of mainly Trump. But for March, this is the March performance, the share price performance for the S3 index. So you saw the REITs recovered in March. But since then, the REITs share prices have come down. But for the first quarter, the year-to-date performance, or rather the first quarter performance for REITs was up 1.9%. Yeah, so as you can see in this chart here. Next slide, please. Yeah, so for the dividend yield spread, it's since fallen due to this is as of end of March. It has fallen, but since then it has also risen already because of the fact that the share price fell and the forward dividend yield rose. So right now is as of end of March, it dipped slightly under the historical average, but as of last week, it's already over the historical average already. So going forward, we think this trend might likely continue, especially since the 10-year yield will likely continue to fall. We see in the chart on the right, the 10-year yield fell 5 basis points month on month and 42 basis points year on year. So as that falls and as the dividend yield spread continues to improve from REITs benefiting from lower interest rates and stable operating performance. So the dividend yield spread is likely to continue to improve. Yeah. So now the dividend yield spread is slightly above the average as of the latest numbers. Yeah, next slide, please. Yeah, so the next slide I have the forward dividend yield and the price to NAV. Yeah, so the forward dividend yield is dipped slightly because of the share price performance, but then again, since then is risen due to the sell-off of the equities markets. So right now it's at still slightly above the historical average, and price to NAV because of the sell down is at 0.8, about 0.83 as of last week. So this is end March numbers. It's still looking cheap. So we think a lot of the negatives has already been priced in, and based on this chart here, usually when it reaches around 0.8 times, we see a rebound in the share prices. So if it follows historical trends, and likely the REITs might start a rebound. Next slide, please. Yeah, so this is how we think the tariffs will affect REITs. So generally, REITs, we see them, or rather we view them as more resilient as compared to other equities, especially since REITs are still, or rather the tenants of all these REITs, they're still contractually obligated to pay rents. So as a result, they are not immediately impacted, assuming no defaults of the tenants. Yeah, so for subsector retail, we still prefer retail. So we think for the tariffs impact on retail, the impact for now is still very limited. But going forward, as more recessionary concerns come in and more recessionary fears come, so there might be some consumption slowdowns. Consumption slow down, but we still prefer suburban malls, especially since suburban malls is focused on essential and non-discretionary spending. So as a result, recession or not, all these tenants will still perform well. And for industrial, we think the impact will be medium. So that is because manufacturing, it may decline with higher tariffs, especially those with more cross-border activities. But there is some reshoring and nearshoring trends that's been seen already. So that is especially seen in Stonework is one of a good example of reshoring and nearshoring trends. They're capitalizing on the fact that a lot of these trends are picking up. So all these tariffs, it might boost this local industrial demand. And for office, mainly for now, we don't think there is much impact in the near term, but in the longer term, there might be some headwinds as basic corporates, they start to hold back on their expansion plans because of prolonged trade tensions and uncertainty. So this is further term impact or over a longer term, but for now, we do not see any tenants pulling back. So limited impact still for office. And for the hospitality sector, these trade tensions might reduce business travel. Leisure travel also might come down or might wane, especially with consumer sentiment weakens amid more recessionary fears. And for the healthcare, no impact because healthcare largely non-cyclical, and patients, if they're sick, is basically still need to see a doctor. So yeah, not more resilient. So low impact from the tariffs. Yeah, next slide, please. Yeah, so we move on to more of subsector in these indicators. So basically, month on month, or rather, year on year, the retail sales index is down. And that's mainly because Chinese New Year was celebrated in January in 2020, this year rather than February last year. So as a result, we see February's numbers down quite significantly while January's numbers were up. But like I mentioned, we still favor retail because of the limited supply, and tenants are still willing to pay higher rent, coupled with occupancy costs that are still below pre-COVID levels. So there is still some room to push rents up for tenants. Yeah, next slide, please. And for the next slide, this is the hotel RevPAR and visitor arrivals trends also. So in January, we saw visitor arrivals and hotel RevPAR improve, and that was slightly surprising for us, mainly because we were expecting it to decline from the very strong base in first quarter of last year, like the many concerts last year, Ed Sheeran, Taylor Swift, Coldplay, Bruno Mars, all in first quarter. So as a result, that was very strong. And so this is more in line like the fact that RevPAR is down. So we're expecting March numbers to be slightly down also. But for the full year, we are still expecting RevPAR and visitor arrivals to improve year on year by about low to mid single digit levels. And visitor arrivals, we expect them to reach around 95 to 100% of pre-COVID levels already. So that is almost back to full pre-COVID recovery. Yeah. Next slide, please. Yeah, so this is our Phillip research coverage list. Yeah, we'll update after the first quarter results as well. Next slide, please. Yeah, so now I'll move on to Phillip on the ground for Core, Keppel Pacific US REIT. So they released their first quarter operational updates last week. So Core is a US office REIT. So for the first quarter operational updates, their distributable income, it's down 19%. So that's mainly due to timing differences because there's higher free rents due to the timing of the leases that were signed. So generally for them, the tenant incentives has been the same from COVID until now. And going forward over the next couple of years, I think it's possible that tenant incentives or tenant improvements and capex might start to the allowance might start to come down. So this year they're expecting about 50 million. So next year maybe 40 to 50 million, and it will likely come down after that as the demand possibly picks up by then. So for them, their capital management is still stable quarter on quarter. So no change for the all-in debt cost, fixed rate, and gearing all remains stable. Portfolio occupancy, it dips slightly. And for the first quarter, the rental reversions were a little bit weak because of the renewal at Bellevue. So it's down 3.6%. But for the outlook for them, they mentioned that they do not, the tenants, there's no feedback from them that and that the demand is waning or tenants are pulling back, holding back on the leases. So no significant impact on the tariffs for now. And they also mentioned that the US banks, they do not have lending presence in Singapore. So mostly it's still Asian banks for their lenders. And US banks are still not lending. I mean, US banks are still not even lending US office. So let alone Singapore companies with US office assets. So that is even harder. Yeah, and for the GSA, which is the General Services Administration, which manages the federal real estate, they are cutting back on leases. So they are not for Core, they are not really impacted because they only have about less than 3% of their portfolio, which are GSA leases. And for them, the most of the spaces cut by the GSA are cut in Washington DC. So those with any Washington DC assets are the hardest hit. So one of the examples, Prime has one property at Washington DC, so that will be hit quite hard. We think. Yeah. Next slide, please. Yeah. So for this is CapitaLand Commercial C REIT. So this news was last week. So CapitaLand Investment, CLCT and CLT, or rather CLI, they plan to list the commercial C REIT in China. Yeah, so the joint investors will be CLCT, CLI, and CLD. So they tend to have a strategic stake of about 20%. So the three combined 20%. And right now, the initial portfolio for this new Plan C REIT listing, which is CLCR, CapitaLand Commercial C REIT, is one of the properties at CLCT, which is the current CapitaLand Commercial Trust in Singapore. So that one is a Capital Mall Yu Hua Ting. So that one is sort of the smaller assets and more mature assets, and another Capital Mall Sky, which is currently owned by CLI and CLD. So those two will be the seed assets for this new CapitaLand Commercial C REIT. And like I mentioned, these three entities will collectively subscribe to 20% of the units in the IPO of this proposed listing of this C REIT, and they have a lockup period of 5 years. Yeah. Next slide, please. Yeah, so more info on this. So this potential listing of this C-REIT is a huge plus for CLI. So first of all, it's a new platform for them to unlock value and of mature retail assets. So this is uh, basically CLI has a strategy to sell off their China assets and lighten their balance sheet. So this is one of a platform for them to do so in the longer term. But in the near term, they can't really do so because there is a 1 year period where they can't really have or rather expand this REIT. So it's like a downtime. And for this normally China C-REITs, the size is relatively smaller than the Singapore REITs because for the current commercial REITs, there only be like 1 to 3 assets inside, and the value is like 2 billion or less. So that's like 500 million. So usually the C REITs are smaller in value. So that is one. And you take a look at the chart on the right. So the stake for CLCR, they only can hold 100% of an asset and they cannot hold a partial stake. So right now they only have two seed assets. And regarding the pipeline of assets, so CLCT they'll retain the right of first refusal for assets from CLI, and CLCR they will also have access to CLI retail assets, but they do not have the ROFR or right of first refusal. Yeah, and for the gearing is slightly different from Singapore's limits. So Singapore is 50%, but for them it's currently at about 28.6%. So how that's calculated is 140% of the NAV of the REIT. So that is the regulatory limit for gearing. Yeah, and it's another plus for them for CLI is that basically they can tap the China domestic capital market as well. So for this CLCR, they do not have any, or rather there's no access for foreign or global players. Like they can't invest in this REIT. Yeah, and like I mentioned, it's a 5-year lockup period for the IPO units. And the expected distribution yield for this CLCR will be 4 to 5%. And it's also expected to IPO at around price to NAV or price to book of 1. So based on the what we've seen for this for the previous, I think there were, if I'm not wrong, there were 8 previous commercial C-REIT listings. So most of these C-REIT listings, usually after the IPO, they will start trading at a higher price to NAV. So that's a plus. And the timeline for this is that it's targeted to list by end of this year. And yeah, CLI will be the asset manager and sponsor for CLCR. Yeah, and regarding and the goal for CLI will definitely to be able to repatriate any money that they get or from CLCR. But right now it's still under discussion. I think there's with more info to come as yeah, we update as more info comes up. Yeah, but for now they're still solving the issue of repatriating money out of China. Yep. So that's all for me. I'll hand over the time now to Zane. Hey, meow meow. Thanks.
And thanks, Darren. Yeah, I'll present on the risk aviation monthly. In March 25, we saw a broad-based sell-off triggered by the US tariff. And assets and SIA engineering was the mostly affected counters. And the share price decreased by more than 11% in March. And this is partially due to the gloomy air cargo outlook and also the potential supply chain disruption for MRO services. Yeah, but SIA and CAO is more resilient compared to the other 2 countries. Next slide, please. And passenger traffic for SIA declined by 0.8% in March 25, and this is partially due to the shifting Easter holiday from March in 24 to April in 2025. And on this fall short of the 2.7% year-on-year increase in capacity. The next slide, please. And for the cargo side, yeah, cargo carriage increased by 7.6% year-on-year, and this was supported by the front-loading activity in anticipation of the tariff. And particularly East Asia load factor improved by 4.4 percentage point. But we do see weaker cargo demand in America and Europe side, which was limiting the overall cargo load factor growth. and the demand is still falling short of capacity growth of 7.7%, and thus resulting to a 3.1 percentage point drop in the load factor to around 57%. The next slide, please. And some update on the US tariff, which is relating to the aviation industry. So in addition to the new tariff which he proposed, US has also announced the cancellation of the de minimis exemption, which will be effective from 2nd May onwards. So in March we do see like a rebound in the air freight cost. So it increased by more than 37% in the month of March. Yeah, next slide, please. And some outlook for the counters. For SIA, we do expect revenue to moderate in FY26 as cargo, which accounted for around like 33% of its third quarter 25 revenue, will be adversely impacted by the US tariff. And passenger yield could also be pressurized due to the weaker consumer spending and also tighter corporate budgeting. However, we'll see cash position to be strengthened, likely to be strengthened in FY26, mainly due to the further delay in capex plan in the middle of the supply chain disruption triggered by the US tariff. And for SETS, its first quarter 26 profit is likely to be supported by the surge in urgent cargo delivery following the implementation of tariff. However, FY26 earnings will no longer be supported by the e-commerce growth in North America. But in contrast, Europe may continue to be benefit from the positive momentum, particularly especially like when Shein is going for London IPO. Yeah, so we could see like further solidification in the region presence, which is expected to increase its e-commerce demand in Europe. And for CAO, we still expect the earnings to be supported by the increased contribution from Shanghai Pudong International Airport. But the effect from tariff is likely to be secondary effect, which will mainly on the consumer confidence and also discretionary spending, such as the overseas holidays may be weighed down by US tariff. And also the growth momentum is expected to be weakened significantly from second quarter 25 onwards, since the likelihood of the near-term bilateral talks is pretty much unlikely to happen. Yeah, so that's all for me. I'll hand over to Ding for technical pause. Thank you.
Thanks, Mel. Good morning, everyone. I'll move on to the technicals. So next slide. Yeah. First up, looking at the S&P 500 last week, for the whole week, it was down 1.5%. So it was mostly consolidating sideways, finding resistance above 5,450. This level was around the closing price when, I think 2 weeks ago, when there was a 10% spike in the S&P 500. And currently holding at a 10-day moving average, the red color line close to 5,250. So I think we could still see some further range bound trading ahead as resistance is still holding at above 5,450, and support is currently around 5,100 to about 5,250. Yeah, and also the volume is coming off a little bit since the index recovered above the 5,000 level recently. Yeah. Next slide. Yeah, so we also looked at how S&P 500 performs following a depth cross signal. So last Monday, there was a depth cross signal being formed where the 50-day moving average actually crossed under the 200-day moving average. So this was the first signal formed in about 3 years' time. The last time was in mid-March 2022. So we look at some of the data points when in the past 10 occurrences of such a depth cross. Usually when depth cross is being formed when there was around average about a 10.9% drawdown from the peak. And following such signals, there's about a 10.6%. Usually there's about a 10.6% more further downside until the market reaches a bottom. And it takes about 92 days to reach this bottom. But in the past 10 occurrences, actually in four of such instances, the market had actually a bottom actually before the death call signal was being formed. So there was no further downside following the market for the market afterwards. The worst case for the market was during the global financial crisis back in 2007, when after the death call signal was being formed, there was additional 55% downside for the market, and it took around over 400 days until the market actually bottomed. Yeah, so that was a worst scenario for the S&P 500 following the death call signal in the past 20 over years. Yeah. Next slide. Yeah, and this table actually looks at the 4 S&P 500 returns following a death call signal in these past 10 occurrences. So this actually looks at the 1 month to 12-month returns. So in general, it's actually quite positive following such the death call signal. So 1 month return is about 0.5% with about 50% chance of it being in the positive. So it's more like a bit of a coin flip in the very near term. But when you stretch out the time frame from 3 months to 12 months, the average return actually increases from 4.7% in 3 months to about 13.4% in 12 months. And the probability of it being in the positive is about 70 to 80%. So it actually bodes more positive in the longer term following such a signal. So in conclusion, when a death call signal is out, it's actually quite inconclusive, as the market could actually have already bottomed following such a signal in 4 of the past 10 occurrences. And when you, in the longer term, there could be actually more towards lean more towards the positive kind of returns following such a signal. Yeah, because the death call signal actually is actually formed using the longer term moving averages, which actually actually there's a bit of lag really from how moving averages are being derived. Yeah, so this is just a study on the death cost. So I'll hand over time to Paul to talk about the Phillip on the ground for TSMC. Thanks.
Yeah, thanks. Yeah, thanks, Zin. So I will move. So Yikban is not around. I think he's gone for a Sunday briefing. So let me just give a brief on some of the highlights. So TSMC released its results. So you can see on the right hand side, the earnings was up almost 60%. If you look at the EPS. TSMC, for those who don't know, is the largest wafer fab. So the revenue beat guidance, and the big driver is the usual AI, the GPUs and so forth. So that's the main driver. They just meant on the tariff impact, they just said that there's no change in customer behavior, so that's why their full year guidance remains. And the other important thing, at least for the Singapore semiconductor companies, is their capex. So they are the semiconductor companies' customer in a way. So if let's say Franken's customer is Applied Material, then Applied Materials' customer is TSMC, because they buy the equipment from TSMC. So the good news is that TSMC is maintaining their equipment guidance of 40 billion in a way, the capex. So the outlook is still remaining strong and so forth. Yeah. Next slide. Next slide. So I move on to ASML. So ASML is the largest lithography machine maker. It's virtually a monopoly. So the revenue was also very strong. They maintain their guidance, especially for the full year, is unchanged at 15% growth year on year. And the drivers continue to be the same. It's usually both logic, which is like your GPUs, the NVIDIA GPUs, AI related, and also memory. Because when you roll out every GPU server, you also need a memory, especially the high bandwidth memory. In terms of the impact, they basically said that the customers is still unclear. I mean, not sure, but they maintain the guidance for now. So the outlook is that they will benefit from the high demand for lithography machines in the next 2 years. Next slide. Move on to he also initiated Soilbuild. So Soilbuild is a construction company, I think the largest construction company. They are many years, I think since 1976. They specialize, so every construction company usually has some specialization. So for them, they specialize more on building like high spec, high floor warehouse. Around 80%. The other unique thing about them as a construction company is that they also have a precast. So precast, not all precast makers are doing well. So for them, they are doing the foundation, that means the walls and the floors. But those precast makers, they are doing the like toilets and other parts, the whole complete set. Those are having some issues because of some quality issues. So they mainly supply the modules to, mainly for HDB. Next slide. So in terms of the highlights, I think the big change for them was that they got this big contract in last year. So this more than doubled the contract. So this will give them at least earnings visibility for the next 2 years. And also the PPVC, the precast is just started to turn profitable. And then we expect with the higher volumes, the earnings will continue to grow for the PPVC because of the next slide, because of the ramp in HDB. So like HDB continues to, you can see here, I mean, they are planning like 50,000. So there's that visibility around 17,000 flats per year. And of course, the usual thing, BCA has guided upwards for the whole industry for construction. Next slide. The risk factors Yip Ban mentioned is the lumpy order book. So, but I think the one thing good is that with the construction guidance given by BCA, there's a bit better visibility. The next slide is the more than 70% of its orders come from private sector. Next slide. So in terms of the valuations, the industry trading around maybe like 9 times. So he's valuing the stock at about 4 times PE. So it's a huge discount because they are just, the rationale is just that they are just turning around right now. So they don't have the track record of earnings. So that's why we're giving a big discount to them. Next slide. So I'll move on to our usual Singapore weekly. So in terms of some of the key macro news that came out, for Singapore alone, we got some at least healthy numbers for RMC, which is a ready-mix concrete. So the ready-mix concrete listed companies are Pan United and Hong Leong Asia. For property sales, so these are new launches property, only a 2% growth compared to the 1,600 units that was sold in February. One of the reasons is that there was only like 500 launches in March compared to February. There was like 1,007 launches. So it's not a reflection of demand, maybe more a reflection of there was lack of new launches. But year to date, that means for the first quarter, the number of units sold in Singapore for new launches, excluding EC, was I think it tripled 190%. There were fewer launches and most of the activity was on the EC. Yeah. And just one data point, I guess, the sweet spot, I'm not sure why you call it sweet spot, but I mean, most of the transactions these days, at least buyers are willing to pay 70% of the transactions are now 2.5 million and below. I'll just do a quick one. For China, basically the key highlight for me was that the properties sold is beginning to stabilize. So as you recall the first bullet point, I think March the floor space sold is down 1%. So this is much better than the last 2-3 years. It was falling like 20% almost per every month. So at least there's some stability coming to the property market. There's also some injection of liquidity going into the loans dispersed. And retail sales is starting to pick up. I mean, it's not a trend, but it's one of the strongest retail sales in China for 13 months. So there is at least some stability coming into the... But of course, all this is before the tariff, and then that impact is still not filtered into the numbers yet. Likewise, we see retail sales in the US is still stable, possibly buying ahead. And motor vehicles just got a big spike in sales. Next slide. So I'll just move on to our usual weekly tactical views. So I think the main headline for last week has been Trump. So Trump saying that he wants to replace Jerome Powell, the Fed chair. So what happens if a politician decides to run a central bank? Again, these are based on studies. I'm not saying that he does, but based on the experience in other emerging markets, there are many countries, I think namely like Turkey, the president wants to run the central bank. So if that happens, the economy will have a fun time in the beginning. The economy will run ahead of potential. So they'll get a growth spurt because even though the economy is running hot, he's just going to keep on cutting rates. But then inflation will jump. Then what happens, like in any emerging market, the investors will start to lose confidence in the currency of the country, start to lose confidence in the bonds, and there will be capital outflows, and the currency will depreciate. The one positive, at least for the rest of the world, is that if the money flows out of the US and then it goes into other countries. So the other point for us, our tactical views, is that in terms of the impact on tariffs so far, like we mentioned, ASML and TSMC did not lower the guidance. But we are still cautious. I think the guidance is almost no meaning because everyone is just waiting. The US officials has mentioned several times that tariffs on semiconductors and tariffs on electronics will be coming soon. So even though TSMC give a guidance, but I mean the guidance have like I said, no value now. So that's why we are a bit cautious because this big overhang needs to clear, needs to see what actually happens. So I think that's why the market is hesitating. But the one sector that's doing well, I guess, apart from gold, maybe is the capital markets. So as Trump continues to talk and come up with all his policies, the trading volumes have started to spike up. So the volume in April, although it's only been the last few weeks, so trading volume in the US and Singapore is up almost 110% and 87% year on year. So this will, of course, benefit brokers, benefit stock exchanges, and benefit banks to a certain extent as the clients want to do hedging, want to do more capital market activity. And so long as he continues to keep on talking and cause volatility, it could be a banner 4 years for the capital markets because each time he says something, there'll be volatility. So the more he talks, the more happy everybody gets if you're in the capital markets. In terms of some of the events that we will have Tesla's results, then we will also have Keppel's results this week, and some home prices and US PMI. The US PMI probably everyone wants to watch and see whether any collapse because of the tariffs. We were supposed to have a LHN webinar tomorrow, but because of the so-called IPO that they're planning to do for Colligu, so they are on the blackout period. So apologies for those who have signed. We also have CNMC, the gold miner, but we're just waiting for them to give us the documents, and then we will submit. We will put out the invite on this Poem's website. It is open to anyone. Next slide. So this is just an illustration of the things that we mentioned. So for Singapore, you can see the big spike in the blue line. So this is what we're trying to play on for Propnex because there's this big volume jump. So year to date is tripled and is tracking, so far sold 3,004 is tracking their estimate of 8,500. Then the one on the right is just a 3-month moving average of trading volumes in the US. So US includes NASDAQ, includes New York Stock Exchange. The blue line, the red line is Singapore, so it's up about 30% if you use a 3-month moving average. So you can see this big spike since Trump got elected, I guess. Next slide. There is some, sorry, the previous slide. So the one on the left is just property. So you can see that the blue line is starting to stabilize. So that's a positive. The issue is the space completed. So the red line is basically construction activity, economic activity in property. So that continues to collapse. So this is of course not good for the Chinese economy. The one on the right, why this is relevant is that you can see that Chinese economy has always boomed when there's loans dispersed. That means liquidity injected into the real economy, and we're starting to see a bit of perk up. It's not a trend, but it's after 2 or 3 years of decline, it's starting to see some bounce off the bottom. Next slide. Then this is just a reflection of the US sales. The one on the right is probably, I guess, more unusual, which is, I guess, expected. The auto sales in March, this is the March number, just skyrocketed. That's up about 10% because I think everyone is jumping ahead of the tariffs on all the auto imports. So I guess it's to be expected, the buying ahead of the tariffs. Next slide. Okay, this is my last slide. So I attended the Genting Singapore AGM. So Genting, of course, is 8.6 billion market cap. It's an integrated casino. So the two peculiar things, I think, like we mentioned in the morning note, there was 2 unusual things mentioned, at least from our point of view, in the AGM. Was firstly, Genting continued to talk about how good their competitor is. I'm not sure why, but so I need some of the reasons why they said the competitor is doing well is that the competitor, number one, has 30,000 rooms around the casino near the CBD, and they can fit business travelers into the Marina Bay Sands. And business travelers are the biggest spenders. Whereas compared to Sentosa, they only have 5,000 rooms, and that will limit the number of gamblers into their casino. The second thing is, of course, the great location near CBD, and there are 2 MRT lines just below the Marina Bay Sands. Then of course, what Genting is trying to do is, of course, they're going to spend on the Resorts World Casino 2.0. They're going to have Minion Land, then they're going to have new hotels, very luxury hotels. they're going to make the aquarium bigger, or 3 times bigger. For Thailand, they are not going to be focused. Since you're going to spend almost 7 billion, you better focus on Singapore. So Thailand, they're probably not going to look at it because the entry for locals is still very high. This is what they're going to spend. Of course, this benefits the construction industry. Most of it is going to be at the 2027 to 2029, the ramp up. So the second peculiar thing in the meeting was a lot of minority shareholders complained that the analysts didn't understand the business. They were too young, and also that they needed to use more foreign analysts to analyze the company. Since I'm old, let me explain why the share price has been so weak. So if you look at this chart here on the left, so the chart here on the left is the casino revenue for Marina Bay Sands in red, and then for Genting Singapore in blue. So you notice that Marina Bay Sands has been grabbing market share. So if you take 2019 to last year, so Marina Bay Sands has been grabbing almost 1 percentage points market share per year. Of course, during the pandemic, everything just, but you can see the widening between Marina Bay Sands revenue and, of course, Genting Singapore. And the worry we have is that even though they are going to spend, it does not mean they can capture the affluent. So by spending 6.8 billion, you are actually doubling your fixed assets, and this will have the risk of your depreciation doubling too. So that is the one thing that it will be the big issue for for Genting. But the big opportunity for Genting will be when the Greater Southern Waterfront opens. So for Greater Southern Waterfront, which they are vacating the premise, probably start construction 2027, I think. But this will be the big opportunity. So this Greater Southern Waterfront, as you know, is the old Keppel Yard. They will have new houses, offices, tourist attraction, and this can at least be the big feed of traffic into into Genting Singapore. But until that happens, I think we worry that Genting will just continue to lose market share to Marina Bay Sands, because Marina Bay Sands is also expanding their casino. Yeah, so I'm not sure how this market share loss can be narrowed, at least in the near term. Thanks. I think I move on to Q&A. Yeah.
Oh,
Let me.
I go first. Okay, thanks, Darren. Yeah, sorry. Yeah, just let me okay, sorry, just let me take a few of the questions first. Yeah, I saw one on Tesla. Yeah, what do you expect from Tesla results tomorrow? Is poor sales priced in from the recent deliveries? Yes, I think it will be priced in, but what do I expect? I don't expect a good quarter at all for Tesla. I believe that it will still be, they will do definitely worse off than they did the last quarter, which was already a bad quarter if you look at it. Firstly, deliveries were down drastically, across almost all their markets, right? Deliveries were down, even though if you look at the bigger picture, the overall EV deliveries actually went up. So the reason for that is that people are moving away from Tesla to competitors, right? If you look at the US market, which is, the Chinese EVs haven't really penetrated the US market yet, right? As heavily as they have in the other countries, mainly because of the tariffs, and the surcharges, surplus taxes on Chinese cars, right? So the other EV car makers, you look at the main US states like Ford, they are actually picking up on the EV sales, whereas Tesla is lacking. And it'd be quite surprising, because you expect that Tesla being the sort of the first company to really start and only sell EVs. You expect them, if the market is growing, they'll grow together with the market. But it's coupled with a lot of factors, the main one being, of course, Elon Musk, right? Whatever he does affects the company. So him joining and backing Trump when he won, right? That was what made deliveries went down. There were also, there were protests outside Tesla companies to protest against Musk. So not say protesting against Tesla cars, but because of Musk and how he's tied so closely to Trump, that's why they were protesting. So whatever he does really affects the company, right? Both positively and negatively. So I think that's the main thing that they might have to fix before they can pick back up again. Deliveries were also poor. If you look at China, China grew, but they still lost market share to the main competitor in China, which is BYD. And now, with all the thing that's going on in the US and the tariffs, right? It might actually shift the whole mindset of a Chinese consumer, especially when they want to buy a car. They might, because of whatever's happening with US, they might just go and buy a Chinese car, right? Even though Tesla is cutting their costs, right? And I'll come to my last point, which is the cost. Why? So the deliveries don't show they only show the number of vehicles that they sell, but they don't show how much is sold at and the main, I guess, the cost as well as the price that they sell at. So this results will show us if they have continued to cut the price of the car, and how much will it affect the revenue. So it might come as a shock, I guess it's priced in already, but maybe there another factor that is not priced in yet is if the cost has increased and the price has gone down. So that will compress their margins. So the margin compression has not been priced in yet, and we will have to see tomorrow. But I guess it will not be a good quarter for them. I think the margin will decline even further in tomorrow's results. Yeah. So that will be the main thing that we'll be looking for, because since we already know the delivery figures. Yeah. And also, of course, whatever he has to say on moving forward, how is he going to progress with the company, if he's still going to talk about his robot, the Optimus robot, and the full self-driving function, which we only see that coming in the medium term at the earliest, although he keeps saying that it's in the near term, but I think that will be only in the medium term. Yeah, so I think it'll be quite not a good quarter for them. Yeah, there's one here. I'll try to answer this. It asks, is Meta Alphabet hurt badly from Shein, Temu cutting down advertising from due to the tariffs? If you look at Shein and Temu, it does show that they will be cutting their US ad spend by, I think, around 20 to 30% approximately, right? But if you look at the whole Meta and Alphabet, this really only represents quite a small slice of their whole digital advertising market, right? The good thing about Meta and Alphabet is that they are very diversified, so they don't just solely put all the eggs in one basket and depend on these Chinese e-commerce sites like Shein, Temu for their digital advertising. They do depend on multiple different avenues of advertising. However, I think so I don't think the impact will be very big, right, from Shein and Temu. But if you look at a greater aspect, whether or not the US advertisers, right, if they start to cut drastically on advertising, then that will hurt them. So it's really mainly I think the whole market, if they start to cut very drastically, then we will see them actually feeling the pinch in terms of their marketing and in terms of the advertising. Because look at Meta, I think more than 90% of their revenue comes from advertising, right? Alphabet less so, but also still a huge chunk of their revenue comes from a lot of from advertising. So Meta will be, I guess, hurt more if advertisers decide to cut down. Yeah, so not just these companies, but Netflix as well will also feel a bit of a pinch because they're trying to shift away from the subscription model to this advertising line of revenue. But they were oddly very positive about the advertising segment of their business. So maybe there is something that we are in the markets that they are doing that we are not aware of. But I feel that if you look at it globally, advertising will start to drop. Yeah, especially if the tariffs do to kick in and the consumers will feel it also. Okay, there's a few about the banks. Let me just go to the banks one. Where is it? Let me find it. Yeah, okay, so the same question here. Two questions is, what's the expectation for the Singapore Bank's first quarter earnings? Is the impact of tariff already baked in, or you reckon it will be reflected in the second quarter results? And also, if the bank's results will be positive, the question jumped. Yeah, if the bank's results will be positive, especially with front loading of export before the tariffs kick in. I think the impact of tariffs hasn't really been. I think it has been, I guess, priced in, right? With the recent, share price performance, but I don't think it'll be reflected in the first quarter earnings yet. You look at using the US banks as a sort of a baseline, right, to see how well they did. I think Singapore banks will still do quite well in the first quarter, right? It will probably meet a lot of our estimates and expectations. But in the second quarter, we will probably see, the loans growth decline, maybe a slight uptick in provisions. But in overall, the net interest margins should hold stable, right? I believe that their margins and their net interest income could possibly improve, right? Because now, as I mentioned earlier, we've seen that the CASA ratio has increased. So their cost of funding is declining. And they're able to put it back now into longer interests in like bonds and get a higher interest, and sort of like be better able to time it out, right? How their net interest margins would look like in the future. Yeah. So I don't think it'll be reflected in the first quarter. Second quarter, we could see a better sort of answer as to how well the banks are taking this tariffs hit, right? But I also mentioned, right, like the manufacturing and ASEAN in general do not make up a very big portion of the bank's loan book, so they might not be impacted as heavily. Yeah, will it be positive, especially the front loading of export? I think it won't really have much of an impact, right? I guess there will be a bit of a give and take, right? Some people hold back, some will want to front load all the exports. So I guess it will sort of nullify each other out. So I think we will still see this mid-single digit kind of growth in terms of their loans. Yeah, but I think the kicker would be for the banks, right? In the first quarter, we will see the trading income surge based on the volatility and the volumes figures that we have already seen for the first quarter of this year. Yeah, so I think that will be the main difference in terms for the banks. Okay, I think that's all. Oh, sorry, yeah. Yeah, why someone asked Glenn, why is UOB still a buy when ASEAN is most hit by Trump's tariffs? Yeah, so I think UOB is still a buy because we believe that even with the Trump's tariffs, right, they had the most positive loans growth guidance, right? They were the only bank among the three of them that said high single digit loans growth. So even if you cut that down to mid single digits, say, we still believe that they are still trying to penetrate into the ASEAN market, right? And it's such a big market that whatever they're doing, they only have really a small slice of the pie currently, and they're trying to expand further. So yes, there might be a hit, but we still believe that the growth for them moving forward will be faster than the other two banks, right? DBS is really hit just by that global average tax levels. OCBC not really doing much. They don't really say what they're doing as well, so we're not certain as to where they are trying to grow. But at least for UOB, there is a clear path, where they are trying to change something. They're trying to grow in a different way instead of just saying, oh, I just give out more SME loans, right? So now they're trying to really push that side. So I guess, yeah, it's more like the growth will be slower. Yeah, not that the growth will just suddenly stop or reverse. Yeah. Yeah, maybe this one about EV manufacturers. Yeah, we don't cover Xiaomi, so a bit hard for me to say. But if you look at the EV manufacturers, you look at the Chinese EV manufacturers, they are still growing very well, right? They firstly don't really depend. The good thing is that they weren't even allowed, or there were so many restrictions on them going into US in the first place. So whatever they put on now and they pile on, right, it doesn't really make a difference because most of them weren't in the US market to begin with. So they were really growing quickly outside of the US. And now that the tariffs have come in, right, it's sort of just isolating the US from the rest. So we might see the Europe market, Asian market, ASEAN market, they might be growing even faster now because they firstly, the Tesla may not be allowed into these markets, or they'll be very expensive. So the Chinese EVs who are already doing it, they'll just come in at a lower price, and they'll get a lot more benefits, say from the government, from these the Europe's government or the EU, where they give a lot of concessions. Yeah, so I guess it will be quite strong growth, but of course, you must choose those the EV manufacturers that have little or no presence in the US. Okay, I think that's all. Yeah, okay. Any updates on the GE saga? Yeah, there's no updates yet on the GE saga. They haven't reached that level in order to do this to do the takeover, to fully privatize the company yet. Anyway, we'll get an update from them in about 2 weeks' time when the results are released. So the banks are releasing on 7, 8, 9 of May. Yeah, 3 of them are consecutively. So we'll get an update, and then we'll give you an update for that. Okay, I think that's all. I hand it over to the rest of my colleagues. Thank you.
Okay, thanks, Glenn. Let me try to take on some questions. Hi, Darren. Microsoft is pulling back from data centers. Does this affect Keppel DC data centers? Yeah, excuse me. Yeah, so first of all, Keppel DC, they do not have any exposure in the US. Yeah, and basically for that Microsoft pulling back on data centers, it's not a new thing, because in the past also, like Google, AWS, we've all seen similar episodes where they pulled back, and whenever they cancel or reduce their projected capex spend, there are some other hyperscalers that demand this, or rather, they go into these projects instead. Like in the past, where AWS and Google, or they cancelled. I believe Meta, they went into some of these projects. So yeah, usually the other hyperscalers will go in. And if you take a look at it holistically, whatever they cancel is still a small proportion of their overall capex spend as well. So it's not really significant. And any cancellations that Microsoft they canceling is also mostly greenfield development projects, or any projects that are not firmly contracted yet. So it's still in a very early phase. So how that does not really affect Keppel DC, because Keppel DC, their assets are all operational, and yeah, they are already completed assets. So that is also different. So Keppel DC, basically, they are not really impacted by the fact that Microsoft is pulling back. Yeah, I hope that answers that. Will Lady Gaga boost the retail and hospitality REITs in May? Yeah, we believe during that week when Lady Gaga is here, definitely the hospitality, the hotels, the RevPAR will grow. Retail spending also will be much higher from tourism, because of course the impact probably might not be as high as Taylor Swift's impact last year. But basically for Lady Gaga, this Mayhem Tour concert is Asia exclusive. So we're expecting a lot of foreigners to come to watch this concert, more than locals actually. So yeah, definitely we believe that international visitor arrivals will pick up from this concert, and the hotel will perform well during this week. The Lady Gaga's here, so yes, we think so. Yeah, and looking at year-on-year performance, I believe last year May there weren't any. So year-on-year basis in May, it should look quite good for RevPAR growth as well. Employees return to office versus federal cuts. Which one has more significance for US office REITs? Yeah, so my personal view is that the return to office will have a more significant than the federal cuts, because when the GSA, like I mentioned during the presentation, or any federal cuts or pullback in leasing mostly affects the Washington DC area only. But a general return to office trend that will help a whole office sector. And it's more of a direct impact, because as more employees return to office, the companies or tenants will likely request more office space as well, or start spending as well. So yeah, it's more of a direct impact for employees returning to office, and the federal rate cuts is not federal rate cuts, the federal cuts on the leases. It might possibly just affect some of the smaller specific markets like Washington DC especially. Yeah, and these leases are usually longer term in nature also, so not so much impact. Yeah, but of course, if you talk about Fed cuts, the biggest one will be federal rate cuts that will definitely help all the REITs also. Then can you comment on the impact of Trump's tariffs on Singapore REITs that have overseas properties, China, Australia, Japan, US, Europe? Yeah, so this one is a very, very broad question. Mostly we have to see which subsector. So in my earlier presentation on REITs, I went into how the different subsectors will be affected. But generally, we think for China, those assets, those REITs with properties in China, those are the worst hit. Especially we see the retaliatory tariffs and such. So China will be the worst hit. Japan, we still think will be more resilient. It's more known as a safe haven country. Australia also not so much impact. We think lesser indirect impact. Yeah, but generally the tariffs are more of a second, third order impact rather than a first order impact. As like I mentioned, it's still the current leases, tenants they still have to pay rents on their current leases. It's more possibly affecting the lease renewal cycles. So it might impact on the longer term. Yeah. So yeah, Europe also we think not really much impacted. US possible onshoring might benefit. Yeah, but it's still in the early days, so still hard to really quantify the impact. Yeah, but mostly it's it depends on the subsector as well, whether they are operating in retail, logistics, industrial, or office. Yeah. Do you think there is any upside of distribution accretive if CLCR listing in view of current tariff headwinds, uncertainties which could dampen Chinese consumer spending? Yeah, so for the CLCR listing, most of the time, or rather based on what we've seen from the previous listings of C-REITs or China REITs, they're listed at price to NAV of around book. So that is already better value as compared to the current price to NAV of like the overseas REITs like Capital Land CLCT, yeah, which is trading at a discount. Yeah, so based on that, really is there is some, like if they monetize the assets there is some value there. And I think there is possible upside, especially from the stake that they will hold in these assets as well, like for CLCT. Like when they divest, or rather when they seed that capital, they are more into CLCR. Yeah, so I think there is some potential upside there, and in view of the current tariff, yeah, so it's still in a very early stage, so we do not really know the numbers exactly, but generally there are some uncertainties regarding the China consumer spending if this tariff continues and recessionary concerns start to come into play. So there is potential that consumption in China could slow. Yeah, so yeah, those are definitely potential headwinds for this series. But now it's still in the very early stages, so we do not really have any numbers there. So we can't really quantify any value. But generally, we think it is possible for it to be accretive. Yeah, C-REIT is positive for CLI. What about for CICT? Yeah, so CICT is not really one of the parties also, so it's not really not really related, I would say, because CIC is more CLI, CLCT, and the Capital Land Development Arm. So it's these three, but it doesn't really impact CICT. So it's more of the fact that perhaps the ROFR that this CLCT has is, or rather, this CLCT still has the ROFR, and this C-REIT does not have the any right of first refusal for the assets. So yeah, I don't really see how this might possibly affect CICT specifically, because they also mostly Singapore focused, also 90% of the portfolio is in Singapore for CICT. So yeah, I don't see much impact on this C-REIT listing for CICT specifically. Yeah. Manulife FA, yes, and TA, yeah, leave the TA to Zane. Yeah, for Manulife FA, we are looking at or rather looking at whether they can improve their portfolio occupancy, and whether their reversions are still are okay this quarter. But mainly they still have to divest. If I'm not wrong, I think I can't really remember off the top of my head, but 100 over million more assets to hit the distribution, the deadline, or rather the recapitalization plan deadline, June. Yeah, so we need some updates by then. If not, they will have breached that, and they have to go back to renegotiate with all the bankers again, and the lenders again. Yeah, if they do not hit that 328 million. So I think there are still about 100 odd million off. Yeah, so they have this second quarter to do that. Yeah, if not, they'll be in a default situation, and they'll have to start renegotiating with the banks all over again. Yeah, yeah, CLI, CICT, please explain if the CLI news is negative for each. Yeah, so for CLCT and CLI, I believe I mentioned that it's a positive for them, as this new series, it is a platform for them to monetize assets, but there is a cooling off period of 1 year. So basically, they can't put in more assets or divest assets there to the C-REIT. And but for now, I believe C-REITs are still, like I mentioned also during the presentation, is still relatively small in China. So a lot of the C-REITs or commercial Chinese REITs, they have like 1 to 3 assets. So it's very small, and the value is like 2 billion yuan. So it's also 2 to 3 billion yuan. So it's not very significant also. And also the regulatory requirements also for any like pipeline assets. So as they only can hold 100% of the asset, as compared to like Singapore REITs, where you can hold a partial stake. Yeah, so there are more regulatory requirements there as well. So it might not be so quick for I mean for the divestments or monetizations at the CLC for CLI and CLCT. Yeah, that is so basically for CLIC. I believe what I try to say is you put 2 CICT there, but I believe, oh sorry, yeah, you put CLCT there. So basically CLI and CLCT is positive, but for CICT specifically, I don't think there is much impact from my point of view, because we are completely different geographies. Yeah, and they also yeah, basically they're also not involved in the IPO stake also. Yeah, so I don't see much impact there. Yeah. Hi Darren, who are the top tenants of Keppel DC? Yeah, so for the top 10 of Keppel DC, they don't disclose, but it's one of the largest hyperscalers. Yeah, you can think of possibly only the big boys. Yeah, 40% of their rental income comes from that. So yeah, it's not really disclosed for their top tenants, but mostly hyperscalers. Can you also share the impact of the tariffs on overseas DCs? Yeah, so for impact of tariffs, we don't see much impact for now on the overseas data center. So during the presentation, I mentioned yeah, like the cutting back And I mean like the sorry, what was that again? The GPU restrictions. Yeah, so that also they are not really significantly impacted because like they handle training. They don't handle training, so their requirements are lesser. So also tariff impact on them might not be as significant as they don't really they will not really hit the regulatory thresholds that are required because they don't really need that much computing power as compared to training. Yeah, so the impact for now is still still not significant. Yeah, hope that answers that question though. Hi, further to the Microsoft pulling back on data centers, they claim it was due to saturation, but can this be said over here and consequently to Keppel DC? Yeah, so for Singapore, yeah, it's really different because of Singapore is limited by space and the demand is still very strong for Singapore also. So like I mentioned during the Keppel DC presentation, I was talking about the first quarter operational updates. The Singapore co-location renewals are likely to still be very strong, especially for the major tenant renewal. So we are expecting like 30-40 rent reversion, mainly because there are not really much there are no alternatives for Singapore and yeah to basically consequently to Keppel DC like what your question stated. So yeah, they're not really it's really a different situation completely. Yeah, so you can't really say that it's a saturation kind of case in Singapore's data center market. Yeah, because basically it's still limited supply and demand is still strong, and yeah, like it's still significant positive rental reversions for renewal of major tenants. So CICT is not going to end up like Mapletree Commercial when the North Asia portfolio gets merged, right? Yeah, this is it's all speculation. I can't really comment on that. Yeah, but I don't think CICT will possibly merge with CLCT or even yeah, I don't think so. Why is Prime US still have a buy rating when there is so many uncertainties in the US? Yeah, so for Prime US REIT, basically they're trading at a very steep discount, and there are some signs of recovery, like the leases signed at positive rent reversion, with more interest rate cuts, possibly the cap rate compression as well. We saw cap rate expansion over the past few years where we saw that portfolio valuations were hit, but going forward, possibly cap rates have already stabilized and likely and maybe might even contract this year, and which results in some positive valuations, but that is still quite some time from now for this year's year-end valuation. But generally there are some signs of recovery we see. But for Prime, they do have one asset at Washington DC. Yeah, that asset we think will still remain weak. But like for the US, the office recovery is is really different across all the different sub geographies or sub markets rather. Yeah, the recovery is really different. Like Washington DC recovery is bad, while some other places in the US are performing much better. Yeah, I think that's all for me. I'll hand over the time to my colleagues. Thanks.
Hi. Thanks, Darren. Sorry, just now I was at another meeting outside. I'll answer some questions. First question is, Soilbuild trading volume too thin. Why lose money buying and holding? Regarding to trading volume, we can't really comment much because it's the SGX markets kind of thing. However, we do have a accumulate recommendation from Soilbuild. For our target price of 0.97, it is a 1-year target price. Yeah, so whether you lose money buying and holding is very hard to say. It's based on how the stock price will move. But we do believe that Soilbuild has good fundamentals and visibility because of their strong order book. Yeah, hopefully that can give some clarity. Sorry, there's some external voice. Continuing with the questions. Is the H200 issue in China market a major setback for NVIDIA? I thought they can sell lower spec GPUs. Yeah, so NVIDIA has their Hopper H200, which is sold in the US. And just to give some background, because previously from the previous tariff war, NVIDIA actually altered the H200 chips into a H20 chips. So this is lower spec GPU that they currently can sell to China. But suddenly Trump came in and implemented a new policy to say that there will be they need to apply for further license before they can even sell these H20 chips. So they recognize directly a 5.5 billion hit to their cost. However, we don't think this 5.5 billion is a very big impact because currently their most recent FY25's net profit is 73 billion. So this 5.5 billion is about 67% of their net profit. I mean, it's not very material, and we saw that Jensen Huang also went to China. There are some negotiation talks. So I'm quite positive that NVIDIA will get through this, like similar to how they got through the previous tariff war by creating a new version of a chip. So I don't think they will be that impacted. One more next question. We heard AGM April 30th any view. Yeah, so the AGM for 30th April for WeHer is just mainly to get the approval for the special dividends. Yeah, so I do think that it will be approved by shareholders because the special dividends will pay out 25 to 30% of their net proceeds from the PBSA sale. Yeah, so I do think that is a very positive for shareholders, which they will likely approve it. Yeah, so hopefully that gives some clarity. Thanks. I'll hand over to my other colleagues.
Hi, I'll take some question. Yeah, does elite rate benefit from 10% lower tariff as compared to EU? We don't think there's a direct impact on elite UK rate. Since their tenant are basically like government tenants, so 99% of the rental are coming from the UK government tenant, such as the Department of Work and Pension. But sentiment-wise, it's definitely good for elite. Since they are engaging with DWP for early renewal ahead of 2028. So they plan to renew like 25% of the total lease by the end of this year. And yeah, so with lower tariff, probably they are in better position to negotiate for higher rents if the geopolitical tension is eased. And some update for 17 Life. Yeah, so their FY24 net profit was still negative at around like 3.2 million, negative 3.2 million. Yeah, and the revenue from live streaming business continued to decline, so it decreased by more than 46% year-on-year in second half 24. And this is contributing to the intensified competition in Japan and also Taiwan, where TikTok is entering into the market aggressively and is occupying more market share. And as a result, the gross profit for Japan decreased by more than 30% or around like 30% year-on-year. And Taiwan also declined by around 20%. And so to adopt the trend, 17 Life actually abolished the exclusive contract requirement for the streamers. And this was like effective from 1st March this year. Yeah, so all contract will be transferred into the non-exclusive contract. So the streamers is able to stream on the other platforms. Yeah, so we believe this will provide more flexibility and therefore will attract more streamers and subsequently boost MAU in FY26. Yeah, so we do expect MAU to reverse its declining trend in the upcoming financial year. I mean, like this financial year. Yeah, and also profit should be supported by its V-lever business, which its profit increased by more than 200% in last financial year. Yeah, that's all for me. I'll hand over to Paul for the rest of the question. Thank you.
I guess I'll take the US question first. So what do you think of US stock like Starbucks and Meta? Also, how about the Magnificent Seven? Any upside in the near future? We don't really cover Starbucks. From what I know, they've been facing quite a bit of slowdown in China market. It's a bit headwind for them for quite some time because China is their second largest market. So weak customer demand really weigh heavily on their results. I mean, the reason their stock was down 20% year to date. So the valuation looks more reasonable, but we think recovery likely still hinges on the China rebound. Moving on to the entire Magnificent Seven, we do see some short-term upside drivers. First is AI monetization theme still remains really strong. So that is the semiconductor, NVIDIA, and the cloud sector, like Amazon, Google. So they're still spending heavily. We do see a slowdown in their AI investment growth rate, but with that being said, their spending growth rate is still like 50%. So for them, it's really about they're worried that they don't spend enough because the moment they don't spend enough, they're gonna be desolate compared to their competitors, and they can't keep up with the demand that's coming in. So the demand from cloud is still very resilient. And the second driver is their earnings are still very resilient. Most of them have very strong balance sheet, and they're all working on their operating leverage. And the third is we think if Fed actually cut rate later in the 2025, it would definitely lift the multiples again. Of course, they do face headwind. The strongest headwind would be the China the tariff exposure. We think it's gonna hit Apple and Tesla the most because these are the two where they actually involved with physical hardware transfer. And for the remaining, of course, they're going to feel the macro softness where the customer weakness or slowing enterprise IT budget. Yeah, so there's that. I think there's another question on the outlook for Alphabet and Intel. We think for Alphabet, like I mentioned just now, the AI was still very strong. So the key focus area for them will probably be how well does their cloud sector do, the Google Cloud, and because they've been trying to meaningfully expand their margin. So that's probably one of the key focus. And the second focus will probably be to see their comment the regulatory challenges that they face, the several ruling regarding their monopoly status. But overall sentiment is pretty optimistic because they have a rather diversified business model and they have the AI strengths. I guess for Intel is a little bit more challenging. The focus would be on their turnaround strategy because they're going through a significant restructuring. They have leadership changes and they're trying to do a lot of cost reduction measures to enhance their efficiency and profitability. Another focus will be on their foundry service. What's the process like? So for Intel, they're facing a lot of stiff competition in the AI and data center market. So how that impact their margin and so it's more a challenging quarter for Intel. So the focus will really be on management's commentary on the turnaround plan and maybe future growth prospects. So that's all from me. I'll pass my time to Paul.
Thanks, Helena. Let me try to do this quick. I think we got a lot of questions. So thanks everyone for the questions. Just we may not be able to answer everything. When will gold peak? Why rally non-stop? I will let Zain do the technicals, but I think in the very near term it looks a bit extended gold price. I think the thing is everyone is so positive on it, and there are reasons too, of course, because of all the volatility and all the risks is elevated because of Trump policies. And the other thing is that if the bond markets bond prices start to drop, or there's a bear market or bond rout, then investors will tend to shift towards to gold, because if you want to park, you want to get out of bonds, right? You either put it in equities, which could also get hurt. So they tend to move it out to gold. So there's some liquidity shifting there, so that will also benefit. But in a very near term, it just looks a bit extended. US bond stocks all fall. What is good to buy? Yeah, I think when you have a recession risk, then everything is risk off. Like we mentioned, some parts that at least looks good will be like defense. Singapore domestic sectors, I think, that are not affected if less economic sensitive, and of course capital markets related, like we highlighted earlier, exchange. I mean the volumes are just skyrocketing for exchanges, for brokers, for someone like Robinhood. I'm not sure. Yeah. Then those are the ones that will still benefit. And of course, gold. So these are the places, very few places, but it doesn't mean they won't get sold down too. Because when everything gets sold down, people start to look for liquidity. There'll be liquidity selling. I mean, they will sell gold holdings because that's the one making money. So I was just saying that fundamentally those are the areas that are benefiting in this environment. Yeah. Hi Paul, what's the impact of treasury rate continues going up? Stock markets go and all like pump, or what's the impact of treasury rates going up? When treasury rates going up, it will be, like we highlighted, positive for gold, because liquidity. If there's a bear market in bonds, people will switch to gold. Maybe even all too, because it drops a bit. US dollar won't be great, because we're just saying that people pulling out liquidity from US bonds. So hopefully they will shift to other countries, maybe emerging markets and so forth. So that would be the theme. Other global markets can fend this off, because they can do fiscal spending to kind of fend off the weakness. I think if China sees there's a big recession coming, they're not going to stand there and just suck on their thumbs. They're always going to do very aggressive fiscal spending. So that's where the liquidity might flow. Yeah. Let me please explain the short-term and long-term treasury bonds movement recently. Yeah, the weakness in short-term bond use is because of the whole trade war that's happening. So there's a bit of geopolitics. I think a lot of maybe sovereign or even foreign institutions want to diversify a bit out of the US treasuries, because they're turning more hostile. Next time I'll show you the slide. There's this, because there's so many slides today I didn't put, but there's this Steve Mirren thing where one of his proposals was to force anyone holding US treasuries to take a century bond. Although unlikely, but there's those things that's spooking investors. So these are some of the reasons why bond yields are switching out. And of course, in the background, the US has, like we mentioned, has a 2 trillion deficit. 2 trillion, not status quo. Even if foreigners don't panic, the US is still issuing 2 trillion to fund the deficit. So even without that, also it's going to be an uphill task for the US to find new buyers of 2 trillion a year. So every year they need to find new buyers for their bonds. I mean, of 2 trillion, excluding refinancing and so forth. What's the impact of geopolitics uncertainty in Japan? I really not an expert on Japanese stocks. Sorry. So I think the only transmission is through the Japanese yen. Yeah. So if people are shifting back out into the Japanese yen, so it'll be negative for Japan equities, because the yen is rising. Again, this is very broad-based thing. What are your thoughts on US long-term bond yields with growing long-term yield more than? Is it better to diversify into? I think to a certain extent, once it crosses 4 or even once it hits 5, then Trump might have to dial back. So Trump might, if you take the view that Trump maybe has to turn a bit more market friendly if bond yields, because he still wants to do interest rate, he still wants to do tax cut. So he can't do tax cut if the bond market is going haywire. There's a bond, there's a boycott in bonds, or there's a bond rout and everything. So if you were to do tax cut, the bond rates are just going to skyrocket even more. So that is the thing, discipline. So you do take a contrarian view. So I think if bond yields start to hit 5, then it might look attractive, because that could be the tolerance level for. So it's the bond markets that's disciplining Donald Trump. I mean, so that's the one view you can take. ST Engineering still got, ST Engineering has hit our target price. I think the share price really went up 50%. The one negative from this whole trade war on ST Engineering is the aircraft. So if airlines start to pull back, there'll be one. The reason why it took up, because there was a contract announced ERP kind of substitute, or our so-called equivalent ERP, the 1.7 billion, but that's over 10 years. So it's not going to be one whole lump sum. So I think the market maybe overreacted to the contract that SC Engineering announced. What's your view on Olam? So for Olam, they are selling their 60+% stake in Olam Agri worth 4 billion. This is of course larger than Olam's market cap. But the problem for Olam is not the market cap, the problem is the debt. So Olam's interest rate is 1.7, interest expense is 1.7 billion a year. If you do the numbers, it's 140 million a month. This company only make 200 million a year. So if they can save interest 1-2 months, they double their earnings. So this is more like a balance sheet story rather than saying the market cap or you sell this, the market cap sum of parts. It's nothing to do with it. The market cap is 4 billion, but the debt in US dollar terms is 24 billion. So by selling this, the debt will drop a bit, 4 billion, but you're still going to get the weight of the interest expense is still there. So I think that is the concern investors have. But if you just look at market cap, of course it looks good, but you got like 22 billion debt US dollar. Sing dollar is probably like, I don't know, 24 billion or more. My maths is not right anyway, yeah. So that's the worry. So even after selling this, their interest expense may not actually, will dial back a little bit. 4 billion will come down, but it's still going to be a big overhang on their earnings. I mean, that's my own view, yeah. Paul, any news today that caused a big gap up? Okay, so the news for Yangzhejiang that took the share price was the authorities confirmed that there will be $120 levy that will climb to $250 by 2028. So there was this big overhang. I think people were worried it could be $200, $300. So the US administration was a bit more. So to 120, to give you some context, currently the container rates is about 2005. Let's took a rough number. So this is about a 4% increase. So I think a lot of container companies can absorb $120 levy for every container from a Chinese shipbuilder. So this is like 4% increase. And the ship rates are down 40%. No? So it may not move the needle in the near term. So I think that overhang was lifted. But I also answered a type question, is this opportunity to sell or buy? I think there'll be some momentum. I think there could be one more round of orders from Yangzhejiang. Then after that, I will be a bit worried because there is no vessels coming from China to the US, right? There's like a virtual lockout of US, of Chinese goods. You can only assume that the container is just going to totally collapse. It's still holding up now because there's still some last minute shipments, but I'll be a bit worried. But I'm just speculating they'll get one more round of orders for Yangzhejiang. Then after that, I think that's it. I mean, that's my own view. Yeah. I'll hand it over to Zane for the technicals. Yeah, thanks for the
Yeah, thanks, Paul. Thanks for all your questions. Sorry, I'll be unable to take all of them, but I'll try to take some. So first up, speaking on gold, it looks a bit overextended on the chart for now. You can see new highs today and breaking above this trendline resistance. So I think for now, something to watch out will be the short-term momentum. So to sustain this short-term strength, it needs to hold above the 5 MA level, which is the around 3,300 level for now. Yeah, then on the weekly also, when you look at the weekly, it's also just hugging the upper Bollinger Band every week. So it's very, very, if it does retreat from the highs of this level, which is around 3350 for now, then we might see a bit of weakness. So there's, I think, two things to watch out for in terms of monitoring the short-term momentum. Okay, I'll take on some of the questions. I think first one, there's a question on oil tech. Yeah, so for oil tech, I think there's a bit of strength coming back since price last week managed to reclaim this 108 breakdown level. Also trading above the 5 MA, some of the short-term moving averages. The blue line is the 5 MA. So currently it's holding around 116 about that. We might still see some short-term momentum holding up, but resistance started to still come in around 122. So we might see some, I think, a bit of sideways because of the previous resistance being formed in March to April this year. Yeah. Okay, then next one is on China aviation. And so for China aviation, I think overall we're still seeing a downtrend. It's a bit of a relief rally for now. So I expect resistance to come in at around this level, 83 cents. Where there's a trend line resistance as well as the 20 ME level where it acted as resistance previously. Also, it's quite close to the breakdown level over here, around 85 cents as well. So I do expect some resistance from 83 cents to 85 cents in the short term and likely to extend this downtrend momentum. Then for 579 Hong Kong is Beijing Dingnan Clean Energy. Yeah, for this, I think the chart still looks quite good. Previously broke out a range consolidation 192 and then their retest over here managed to hold as support even though the market condition, the sentiment wasn't good, and then continue to rebound. So I think there's a sign of strength. We're likely to see a retest of this 217, then maybe do a bit of a consolidation, and I think if there's a breakout again, it could retest this 228 previous swing high level. So I think overall the structure still looks good for now. Okay, then next question is on Singtel. Yeah, so for Singtel, I think still one of the more resilient counters for now, with the breakout of 364 last week. So around 380, there's some resistance. Then the next resistance possibly around 386 and 392. Yeah, so I think overall for now still very strong, still holding about 5-day ME. Yeah, I think I expect this uptrend to actually continue. Yeah. Next one is on Fraser Centrepoint Trust. Yeah, so for Fraser Centrepoint, I think also there's some resilience from the recover above this 210 level. Previous resistance still holding at some support despite the market volatility, and then we are seeing the price actually retest this 222 level. So I think we could see a bit of a slight consolidation, and I think afterwards, as long as 217 holds, I think we could see some further upside to test 228 again. Yeah. So this one, FCT also looking resilient. Then for ESR, I think still looks pretty weak. Yeah, so overall it's a downtrend kind of chart. Also broke down below 24.5 cents and recently around 22 cents areas. So I think there could still be some further downside. Yeah, just continue on the downtrend. Yeah, so that's for ESR. Okay, then for Manulife VS REIT TA. Okay, so for Manulife VS REIT, I think overall the downtrend is still holding quite strong. Price is finding resistance from the 5 and 10-day ME. So like around 0.060 discount the level. And then recently made a lower low as well. So I expect the downtrend to actually continue. Perhaps to retest this 0.054 as well as 0.049 next support levels. Okay, then I think there's some questions on the indices as well as the 3 local banks. So for STI, I think a bit of continue on a bit of a rebound from this very important channel support around 3,390. So for now, I think can expect a bit of resistance in the near term when it touches close to the 3,000 above 3,800, because previously this was the gap down. And then also we have some long-term moving averages also here at 50 as well as 100 MAs. Previously acted as a support. So I think over here we can expect a bit of resistance to come in from this after this bit of a strong rebound in the short term. But yeah, I think afterwards, I think the pullback will likely to make a higher low, possibly around 3,700 about it. Okay, then for the KLCI index, for KLCI, I think it doesn't look as strong. Overall, it's still trading in this downtrend channel over here since the breakdown in start of this year in January. So I do expect some resistance to come in around this 1,500 to 1,530 level. Where previously this was a breakdown. And then there's also a 20-day ME resistance previously, which has acted as resistance along the way during this downtrend. Yeah, so I think KLCI not as strong. Yeah, so we might see some resistance from 1,500 to 1,500. Then for the Dow Jones, I think still seeing overall still there's still some weakness because what they did last week was just a retest of this previous trend support, now holding as resistance over here around 40,300. So seeing a bit of a pullback today, seeing a bit of a pullback last week, and then also close below the 10-day MA as well. So we might see I think we might see some further pullback hit, some near-term support levels, probably around 38,500 and then around 37,300 next. Yeah. So I expect some short-term weakness to continue. Okay, now I'll touch on the three local banks. Yeah, then I'll end the TA portion. So for DBS, continue to see a bit of a rebound. Its price is holding up above the short-term moving averages, the 5 and 10 MA in blue as well as in red. So I think we could still see a bit of further rebound, perhaps to retest maybe around 42.30 to about $43. Then I expect some resistance from this previous support breakdown. Yeah, also there's a bit of strength currently because price also on Thursday managed to break above this 200 MA purple line resistance as well. So previously this was a bit of resistance during the market sell down, then subsequently there's a bit of strength coming back. So that's why it's a bit of rebound happening. I think for the other two banks it's quite similar as well. See, for UOB, price is also breaking above 34.50 resistance. So a bit of a strength for now. I think we could see some resistance from about 35.80. The next one is around 36.80. 36.80 will be quite a strong resistance from the support breakdown as well as the 50 and 100-day MA retest if it does go there. Yeah, then last one I'll talk about is OCBC, also breaking above the resistance of 1580. So some short-term rebound. We'll take it perhaps to maybe 1650 to 1680 will be a strong resistance from the conference of the 550 and 100 MA levels. Yeah, so in general, for the three local banks, I think some further upside. But I think some further rebound, but I think expect some resistance from the previous breakdown levels. Yeah, as with the STI, we might see a bit of a further rebound as well. I think so that's for the TA portion. Sorry, I'm unable to take all the questions due to time constraint, but feel free to post whatever questions you have in the P3 community group on TA. Then I'll take it over there. Yeah, thanks for all your questions today. Yeah, I have a time back to Paul.
Yeah, so thanks everyone. Thanks everyone. Sorry, this one, the US dollar thing. So I'm not sure as you were asking me, I just have to go and look at the Truth Social to go and see what is he tweeting about. Again, these days you just have to see what he tweets in reality, but he seems to be dialing back a bit. So I think if there's some Iran deal, some trade deals done, I think the US dollar could strengthen because I think, like I said, he always takes extreme positions when he negotiates, then he's dialing back. So he seems to be doing a bit of dialing back. Like the fees on all the Chinese-made vessels is actually quite light. So there's some dialing back on some of his extreme policies. So that could help the dollar in the very near term. Again, this is all guess. I know the next 5 minutes he could just tweet something, but this is my own guess. So with that, thanks everyone. Sorry we pushed the 1 PM a bit long today. So thank you everyone for your time and I hope you have a wonderful week ahead. Thank you everybody. Take care. Bye-bye.